Sarah was convinced she had made a smart financial move. She had transferred her savings into a high-yield account offering 4.5% interest. She had done the legwork, read the comparisons, and decided the standard savings account was a losing game. While her neighbors were stuck at 0.45%, she was pulling in 10 times that amount. Problem solved, right? Wrong. Her bank was still profiting far more from her deposit than she ever would. And what her high-yield account was doing behind the scenes? She could have done it herself and kept every penny of the return. But here's what really hits hard. Her neighbor, Daniel, still had $20,000 parked in a basic savings account. Over 12 months, his bank handed him $76 in interest. Over those same 12 months, that bank used his $20,000 to generate over $1,200 in revenue. Daniel got 76. The bank pocketed the rest, and Daniel sent them a 5-star review. He had no idea he was the product. Sarah thought she had escaped the trap. They were both caught, just at different levels of the same system. MoneyMind did the full breakdown. Here's the truth your bank hopes you never piece together. Daniel followed the playbook perfectly. He saved 6 months' worth of expenses. He deposited it at a reputable national bank. Every month he logged in, saw a small interest deposit, and felt like a responsible adult. It wasn't much, a couple dollars here, a few there, but it felt like the right thing to do. His account was paying 0.38%. APY, that's the current national average, according to FDIC data. On $20,000, that works out to $76 a year, about $6 and change per month, less than a fast food meal. What Daniel never thought about was what the bank was doing with his $20,000 while it sat there. He probably imagined it locked in some secure room, untouched, waiting for him. It wasn't. The instant Daniel made that deposit, the bank deployed that money. Not for Daniel's benefit, for theirs. Here's the breakdown of what Daniel's bank did with his $20,000. The primary move, they lent it out. That is the fundamental business model of every U.S. bank. Take deposits, pay a fraction of a percent, lend that money to borrowers at significantly higher rates. The gap between what they pay, depositors, and what they earn from borrowers is called the net interest margin. Right now, the average net interest margin for American banks sits at 3.39%, the highest it has been since 2019. In concrete terms, Daniel's bank paid him 0.38%. They earned an average of 3.39% on the loans they funded with his deposit. On $20,000, that's roughly $600 in spread that the bank captured. Daniel received $76. The bank collected $602 from the same pile of money. And that's just the average. The margins get much wider depending on the loan type. Credit cards. The average APR in the first quarter of 2026 is sitting at 21%. Daniel's bank accepts deposits at 0.38% and turns around and lends that capital to cardholders at 21%. That's more than a 20-point spread. Even if only a slice of Daniel's deposit was funneled into credit card lending, the profit on that portion alone would eclipse his entire year of interest payments. Auto loans currently average around 7.5%. Mortgages are hovering near 6.8%. Personal loans are running around 12%. Every one of those lending products is funded in part by deposits like Daniel's, and every one of them earns the bank several multiples of what Daniel ever sees. Then there's the Treasury play, and this one should stop you in your tracks. Banks take a portion of deposits and buy short-term U.S. Treasury bills. Right now, 3-month T-bills are yielding around 3.6%. The bank buys those treasuries using Daniel's money, earns 3.6% and pays Daniel 0.38%. That's a 3.22% spread on an instrument Daniel could have purchased on his own. The bank is literally inserting itself between Daniel and the U.S. government and charging him over 3% for being in the middle. And that's before we get to the fees. American banks collected an estimated $12.1 billion out in overdraft fees, NSF charges, ATM costs, maintenance fees, and miscellaneous service charges in a single year. JP Morgan Chase alone pulled in over $1 billion overdraft fees in 2024. Wells Fargo came in at nearly the same number. These fees come from the very customers whose deposits power the bank's entire lending engine. Daniel's $20,000 is a cog in that machine. On top of that, interchange revenue from every debit card swipe, float income from holding transaction funds for a day or two before settlement, and revenue from anonymized spending data packaged and sold to marketing partners. Every one of those streams is built on Daniel's deposit. Put it all together, and the picture is undeniable. Daniel's bank didn't safeguard his money. They rented it. They paid him $76 a year for full access to his $20,000, used it however they saw fit, and Daniel walked away feeling like he was earning interest. Now let's talk about Sarah. Sarah is the person watching this right now thinking, I already figured this out. That's exactly why I switched to high yield. And she's not wrong to think that. She's miles ahead of Daniel. Her account is paying 4.5% while his sits at 0.38%. On $20,000, Sarah is earning around $900 annually compared to Daniel's $76. She researched it. She acted on it. She's earning 10 times the national average. So what's the issue? Problem 1, that 4.5% may not be what Sarah is actually receiving. Many high-yield accounts advertise up to a certain rate, and that phrase carries a lot of weight. Some use tiered structures where the top rate only applies to the first $500 or $1,000. Beyond that threshold, the rate steps down. Others feature a promotional rate for the opening months, then quietly roll it back. Sarah saw 4.5% in the headline. Her effective rate may be meaningfully lower. Problem 2, the tax treatment. Interest from any savings account, high yield or not, is classified as ordinary income. That means it's subject to federal taxes, plus state and local income taxes where applicable. If Sarah is in the 22% federal bracket and lives in a state with a 5% income tax, she's surrendering more than a quarter of her interest to the government. Her $900 becomes roughly $657 after taxes. Problem 3, and this is the one that changes the conversation, is what her high-yield savings account is actually doing with her money. Where does the bank get the returns to pay 4.5%? The same place Daniel's bank does. They're lending it out. They're buying treasuries. They're running the same profit engine. The only difference is that a high-yield account passes back a larger share of the earnings. But the bank is still the middleman, and the middleman still takes a cut. Here's the question Sarah never thought to ask. If the bank is using my deposit to buy Treasury bills yielding 3.6%, why don't I just buy the Treasury bills myself? MoneyMind ran the numbers. Same $20,000, same 12 months. 3 scenarios. Scenario 1, Daniel's traditional savings account at 0.38%. APY, gross interest, 76. After federal and state taxes, he keeps roughly 55 lives. That's 12 months of disciplined saving. Scenario 2, Sarah's high-yield savings account at 4.5%. APY, gross interest, $900. After combined federal and state taxes at 27%, she keeps about $657, a significant improvement. But every dollar of that interest is taxed at both levels. Scenario 3, a short-term Treasury bill ETF like SGOV, the 12-month trailing. Yield as of April 2026 is 3.95%, with a 30-day SEC yield of 3.55%. On $20,000, that's approximately $790 in gross income at the trailing yield, or around $700 at the current 30-day rate. Here's where it shifts. Interest from U.S. Treasury. Securities is exempt from state and local income taxes. That's federal law. Sarah pays federal plus state tax on her $900. The SGOV investor pays only federal tax on their $790. After taxes, the SGOV investor keeps around $616 at the trailing yield, with zero state or local tax applied. Now, you might point out that Sarah's 4.5% still comes out slightly ahead in raw dollars. In this specific comparison, yes. But here's what that misses. Sarah's 4.5% is a rate the bank can drop without warning. They can move it to 3.5% next month and bury the notification in an email. SGOV's yield is tied directly to Treasury bill rates set at U.S. government auctions. It's transparent. It moves with the market. There's no promotional window, no fine print. Sarah's rate is subject to full state income tax. SGOV is not in high-tax states like California or New York. That exemption alone can close or flip the gap entirely. And Sarah's high-yield account is still a middleman arrangement. SGOV removes the middleman completely. You're lending directly to the federal government through Treasury bills, keeping the full yield minus a 0.09% annual fee. The point isn't that one option dominates the other in every possible situation. The point is that Sarah never knew the option existed. She thought the high-yield account was the destination. It isn't. It's a more comfortable seat on the same train. So here's what MoneyMind recommends. It's more straightforward than most people expect. Step 1. Keep your checking account. Don't touch it. You still need it for recurring expenses, rent, utilities, groceries, anything flowing in and out on a regular basis. This isn't about overhauling your spending. It's about repositioning your idle money. Step 2. Identify your idle cash. That means your emergency fund, money waiting to be deployed, savings earmarked for a future purchase or down payment. This is the money sitting in a savings account right now. earning almost nothing, while your bank earns 10 to 50 times more on it. Step 3. Here are your options for moving that cash. Option 1. A Treasury bill ETF like SGOV. You purchase it through any brokerage. Fidelity, Schwab, Robinhood, Webull. Wherever you already have an account. You buy it exactly like a stock. The ETF pools money into U.S. Treasury bills maturing within 3 months. Each month, you receive a dividend that represents the interest income. Current yield is in the 3.55% to 3.95% range depending on the measure. When you want your money back, you sell during market hours. The price stays close to $100 by design. The expense ratio is 0.09%. On $20,000, that's $18 a year. And your distributions are exempt from state and local income tax. Option 2, TreasuryDirect.gov. This is the government's own portal for purchasing Treasury bills directly. No brokerage, no ETF wrapper, no expense ratio at all. You open an account, link your bank, and buy T-bills at auction. They mature, and you receive your principal back with interest. The trade-off is liquidity. You're committing to a fixed maturity window of 4 weeks to 52 weeks. If you don't need instant access, this is the most direct way to eliminate the middleman entirely. Option 3, a money market fund through a brokerage like Fidelity, Schwab, or Vanguard. These funds invest in short-term government securities and high-quality short-term instruments. They offer daily liquidity, accessible whenever you need it. Yields are currently in line with high-yield savings accounts. If you choose a Treasury-only money market fund, you get the same state tax exemption as SGOV. Now, the most common objection, but my savings account has FDIC insurance. That's correct. FDIC coverage protects up to $250,000 per depositor per bank. If the bank collapses, the federal government makes you whole. That's a genuine and meaningful protection. But consider what you're actually comparing. Treasury bills are debt instruments, issued by the same U.S. federal government that stands behind the FDIC. When you buy a Treasury bill, you are the lender and the U.S. government is the borrower. The possibility of default is effectively zero. The government retains the ability to issue currency to service its obligations. You are not sacrificing safety when you move from a savings account to treasuries. You're shifting from a government guarantee on your bank deposit to lending directly to that same government. In many respects, it's a more direct relationship. The second objection, I need to be able to access my money immediately. Understood. Which is why you keep your checking account funded for day-to-day needs. For your emergency fund held in something like SGOV, yes, there is a 1 to 2 business day settlement window after you sell. But honestly, when is the last time you needed $20,000 in cash within the hour? In a genuine emergency, a couple of business days is almost always workable. And the additional yield you collect while waiting for that emergency to arrive adds up to hundreds of dollars per year. Daniel was responsible. He saved consistently. He kept the money accessible. He followed every rule he was ever taught. Sarah was informed. She upgraded her account. She earned 10 times what Daniel earned. She thought she had found the answer. But neither one ever asked the foundational question, what is my bank actually doing with my money? And is there a way to do it myself? There is. Your bank takes your deposit, buys treasuries, lends to borrowers at 7%, 12%, 21%, and returns a fraction of a percent to you. The sharpest move isn't hunting for a better savings account rate. It's asking whether you need to go through a bank at all. If this breakdown revealed something about your money you hadn't seen before, subscribe to Money Mind and turn on notifications. We unpack the hidden mechanics behind the financial decisions you make every day. The next one, you'll want to watch it.